G'day, I'm Scotty North, and this is Zenium Live, where we talk all things money, finance, and property. And today's show, I'm joined by PJ Patterson from Keystone. How you going, PJ?
I'm great, Scotty. I'm here outside the White House waiting to see who is going to move in soon.
Well, yeah, look,
It's unsure at the moment.
yeah, it is very unsure, and we titled this "The Race That Stops the Globe" because on Tuesday this week we had the Melbourne Cup in Australia, and that's the race that stops the nation. But this
It
race
is.
has not only stopped the globe at the moment; we're all infatuated with it. It seems, and there's no end in sight just yet.
No, there's no end in sight. Unfortunately, it's a very, very tight race still with a number of key states very, very close on the vote count. So Pennsylvania, North Carolina, Georgia, Nevada, and Alaska have yet to be called. And with Donald Trump sitting on, I think, 214 electoral votes and Joe Biden sitting on, I think, 230
Yes,
something.
two. No, I think he was up. I mean, depends who you read. It was looked like he was up
Yeah.
to almost 264.
Well, there you go. Sorry, 264. Yeah. All Joe Biden, effectively needs to do right now is just secure any number of those states, any one of them, and he is the new president elect of the U.S. So um, it's no surprise really that this has occurred. Many people knew it was going to be a very tight election, despite all the polls. Listening to the radio this morning and commentary about pollsters, I think the public and many people have figured out that pollsters actually have no idea what's going on because they called for a landslide victory by Joe Biden, but it's been anything but. I think there's only a couple million votes between the two of them in many states. Again, minimal difference in the number of votes one way or the other. So it's a really tight race, and just goes to show you that the country over there, the U.S., is probably still pretty divided in terms of who they like and don't like.
Yeah, for sure. And look, I think that while we're not necessarily here to talk about Joe and Don, the Don, we are talking about the stocks and shares and how they've responded. Because from what I've been seeing, it's not exactly acting how I thought it would. With an uncertain election, I thought there'd be a lot of uncertainty in the stock market, and that would reflect that in perhaps people withdrawing from it and acting in that same sort of manner. But I don't know what's going on, but it looks like it's up to me.
Yes, well, the uncertainty, we were not short on uncertainty in the lead up to the election. So I would suggest to you, if you went back and looked over the last 5 to 7 trading days, notwithstanding the last day of trading on the New York Stock Exchange, the market was exceptionally volatile. Volatility was rising across a number of the key volatility metrics that I look at, a number of the key indexes rising a lot, and we were seeing a sell-off into the election. Now, oftentimes that can happen. You see people positioning for a certain outcome, but all of a sudden yesterday and overnight, as the election unfolded, for whatever reason, traders and investors gained more confidence and started to reposition their portfolios. So they started to buy. They started to buy treasuries and drive up the price of those. So interest rates decreasing across the spectrum there in the U.S. They started to buy equities, in particular tech, and broadly other indexes, and just started putting money back to work in the market. So the volatility, we had it. It subsided briefly, so it's come off quite a bit, which is a good thing. You don't want a lot of volatility in markets because it makes them much more investable when you don't have volatility. But we shall see how this unfolds over the next couple of days. If there's a contested election, who knows what that'll do to markets. But I think there was a lot, obviously, of uncertainty in the lead up to the election. And now that we've got the election out of the way, and it's really, one way or the other, we know it's likely to be Joe Biden at this stage, I think. That's given certainty back to markets.
Yeah, it's funny, sort of that, isn't it? So we sort of planned our show today based on the fact that there would be a winner announced, and we can look at the activity of the market and plan for what's going forward and make some commentary around that. We're nowhere near to a winner being announced, And as you said, it could be some days until that is actually happened. But in the meantime, you're saying volatility's down, but the performance of the market's been up. I mean, to me, it's like upside down land.
Well, again, performance, volatility and market performance are inextricably linked. So as volatility rises, and it's one of the key things I look at in my business, as volatility rises, the stock market is falling. And that's a relationship that's very well known. So one of the reasons volatility rises is because typically you're seeing sell-offs in the market. And so again, last week we had a lot of volatility. We had the markets declining. And I think now that we finally gotten to the day, and now the day after the election, the markets, for whatever reason, they've just gone, okay, well, the reality is that either candidate whoever wins is going to unleash unprecedented stimulus on the U.S. economy. They're going to try to do their best to fix it. So I think that Wall Street, people that invest in equities, et cetera, have figured that out and have realized that, you know what, it actually doesn't matter whether it's Biden in the chair or Trump in the chair. We're going to get a massive stimulus package, and that's going to be good for stocks over the long term.
Look, I agree. And I think that we've made the commentary before that any time that once an election has happened and the winner is either perceived or locked in, etc., then that in itself creates stability, because now for the next 4 years, there's no other election, right? So we know that this person is going to be in the chair for that length of time. So by default of having the election, people seem to move on. I don't know why there's like this yardstick in the middle of someone's planning or life or whatever, and then once that's done, it's like, oh, okay, we're back to normal, even though we still don't really know what's going on.
Yeah, indeed. And so again, one day does not make a market or a trend, but certainly, it's a good sign that we haven't had all this rioting and all this other stuff that was predicted, civil unrest. I guess really the only thing they need to do now is probably do the recount. I think Trump has called for recount in Wisconsin because it's such a tight race there. There's a number of postal votes, I think, that still need to be counted probably in these key states. So look, this could play out over the next week or two before we actually know precisely who the winner is. I have a feeling, though, that one of them will concede probably in the next few days. I think the writing will probably be on the wall and they'll be advised to just concede. These personalities, though, between these two are pretty big, so I don't know which one of them it'll be. But it's going to be an interesting next couple of days. There's no doubt about that.
Mate, it sure is. And reference back to the Melbourne Cup, I mean, there was a tragedy with one of the horses there on that track for that race this year again, and they went to the back of the pack and ended up having to euthanize, which is very unfortunate for such a beautiful animal. Let's hope the same thing doesn't happen to the loser of the presidential election, right?
Well, I think the Secret Service probably have something to say about trying to euthanize a president, but nevertheless, look, as I said a moment ago, it really doesn't matter who ends up in the chair. The reality is they're going to unleash a lot of stimulus in the U.S. They're going to try to fix the economy. They're going to try to get the country back to, moving forward in a direction where it benefits all Americans, and hopefully reasserting leadership both morally and economically in the world, and just trying to get us out of this whole COVID doldrum thing. And to that end, I know we're probably wanting to pivot away from politics now and start talking about the economy and what's going on out there, because Australia, of course, has had a good couple of days on the share markets, and it's looking very much like, as I had discussed in one of our last interviews, where I was discussing the quad model. Australia is very well positioned now, in certainly we'll see it in the first half of 2021 to really start to grow. So one of the things we're seeing now around the world, except for Europe is still in a bit of a mess because they're having their second wave of COVID. So they're shutting down again, and all their economic data is really, really bad. So Europe is yet to get through this sort of phase 3 of the economic recovery. So they've got a bit more pain to go. But everywhere else around the world, particularly Asia Pacific, Australia, New Zealand, the U.S. is getting there, and we'll see again if their stimulus package, that they roll out probably late this year or early next year, what it looks like. But the reality is we've seen manufacturing growth begin to accelerate. We're beginning to see life in the services industry. And that's real important, because the services industry actually contributes roughly 63% of global output. So it's a massive figure, the services sector, services industries, in their contribution to the global economy. So we need to see, travel resume. We need to see people getting back out and socializing and going to pubs and clubs and shopping and doing all of the things that we did before COVID hit us. So if we continue on this trajectory, the rate of change of a lot of this data is positive, and that's a good sign for the global economy. And again, particularly that Asia Pacific region that Australia resides in. So as I mentioned before in one of our previous shows, Australia, I think, is going to have a cracking first half of next year with a lot of positive things happening. RBA gave us a gift on Melbourne Cup Day as well by reducing rates to 0.1%. They cut.
Yes, I wanted to talk about 15. That. Yeah.
Yeah. So anyway, there's a lot of support out there.
Yeah, well, there is. And so on that rate cut that you mentioned there, so it was at 0.25, right?
It was at 0.25, and they shaved another
went down
0.15.
All right. So here's the thing. So normally not normally, in the past, they've dropped a whole 0.25%, right? So 25 points. They've dropped 15 this time. Mm-hmm. So there's one view of train of thought that says they haven't dropped rates as much as in previous times, right? Which is fair enough because there's not too much else to go, right?
No, there's not.
But there's another train of thought which I think has merit, is that, well, that was a 60% rate cut.
Yeah, you could look at it that way. Yeah, that's exactly right.
That's substantial, right? I mean, so when we're talking the percentages on such small numbers, like that's a big deal. You dropped 0.15% out of 0.25. That's 60%. That's not a small amount. Now, what's it going to do? Well, we'll have to see. But I mean, when you base rates at virtually zero, and as we talked about in our last show, that the RBA has said that rates are going to be like this for a very long period of time.
Yes,
mate, this is no cost money.
Yeah, it's a real interesting world we live in now with all the cheap and easy money out there. I should say cheap and not easy because, of course, banks have had to tighten up on their credit standards. There's been a lot of work done around that with the Basel initiatives, requiring banks to have more tier one capital, this sort of thing, tightening of lending standards and criteria in Australia, and a number of other sort of prudential measures that have been put in place to make sure that we don't go crazy with the borrowing. But certainly the rates are unprecedentedly low. This is as low as they've ever been in the history of Australia and probably in many parts of the world, history of the world. And what it will bring, who knows? It usually takes a good 3 to 6 months to see these sorts of things work their way through the economy. But I guess the point of bringing this up and discussing it is to say that the Reserve Bank of Australia has come out absolutely saying that they're supportive with monetary policy and they want us to get our economy growing again. The government, as we know, at the last budget, rolled out a pretty good budget initiative with a lot of spending and a lot of support for our economy. So again, this is why I think we're set up very well for the first half of next year to start to see these things working their way through the economy. Notwithstanding if we have any other out of the box event or black swan, as they're referred to, that could interrupt that. But where the table is set, let's put it that way, the table is set for us to really kick off some serious recovery next year.
You'd be really disappointed if you lived in WA and everyone kept talking about this black swan event, because you'd be sitting there going, oh, we're screwed, right? We've got black swans everywhere.
They do. I think you're right. And that's where they were originally discovered, I think, by the Dutch. They only had white swans. And then some Dutch explorers landed in WA and went, oh, there's this thing called a black swan. There you go. I guess the one thing we're going to need to really start to look out for in Australia now over the next couple of years is inflation, and to see what that does. So the only thing that I think could ruin the party, as it were, with the Reserve Bank and their interest rate policy would be if inflation began to rip to the upside. Now, I don't know that that's a very likely thing to occur because we've seen such a large amount of economic damage occur. I think once, getting us back to just normalcy will not cause a lot of inflation. But the Australian currency should begin to appreciate as well through the course of the next 3, 6, 9 months, which will help us absorb any sort of inflation that we see in commodities and oil and those sorts of things. So the inverse to that, of course, is the U.S. dollar, and that will be continue to decline. That's a very well-known position right now, that they want the dollar to decline and to continue to decline. So we should see at least some more strength in the Aussie dollar, which will help offset some of the inflationary pressures that we'll undoubtedly see, as I said, in commodities, oil, agriculture, that sort of stuff.
So it's the old race to the bottom again for the US. So my question on that was, what happens if inflation is above interest rate? Right? We're very much in that position now, and it's not really a position where we've necessarily been before as a country.
Well, inflation probably already is running above interest rates. So really, the people that get hurt the most by that are savers. So can recall a few years ago, you could get a 2 or 3 year term deposit, and the rates were somewhere in the 3% range. Well, nowadays, a 2 or 3 year term deposit is probably, well less than 1%. It's probably 70 or 80 or 90 basis points or something like that. Maybe you could get 1%. But the inflation rate is probably still, real inflation is probably still running somewhere between 1% and 2%. It's a difficult thing to measure, but it's probably somewhere in that range. So the people that get hurt the most are your retirees on fixed incomes who have their money, say, sitting in the bank or in very low yielding securities or something of that nature, like a term deposit. They are going to get hosed completely by these low interest rates. In fact, it's almost, you could call it a war on savers with having such low interest rates.
Yeah, I was talking to an elderly client the other day, or actually 2 weeks ago, and their position was such that they owned everything, they were retired, they were self-funded, and they essentially were living off term deposits. They had a pool of cash. However, in the past 2 years, as you've said, that's changed substantially. So, your $1 million that was getting 30 grand is now getting 10, 12,000 or something. That's a big difference in their return, which was the cash that they lived on. They lived off their cash pool. So they were actually thinking about, it's not without risk, but they're aware of that. But they were thinking about helping some of the grandchildren with housing and actually being the bank, taking first mortgage on a position on some of the grandchildren's houses they're looking to buy. Same situation, deposits and all that sort of stuff, because they were going to get a much higher return, and they had mortgage on the property. My point's not necessarily promoting that as a strategy, but people are looking now for ways to get their capital working because it's not working in banks.
Yes, it's a major concern, and maybe the topic for our next show should be something like how to invest in a low interest rate environment for yield and capital growth. And one of my pet peeves in financial planning is this notion that the moment you retire or you turn 65 and you retire, you go on a pension, you have to take all of your assets out of the share market or out of growth strategies and that sort of thing and put them in all of this defensive stuff like a term deposit or really super defensive investments. And that is such a ridiculous notion that if you're 65, your life expectancy in Australia is 84, 85 if you're a female, and 83, 84 if you're a male. And so you've got another at least 20 years to live. And you've just highlighted something there, which is a serious concern, which is those retirees who choose to go very defensive and put everything in term deposits, they're going to see their capital begin to dwindle because they're going to have to draw down on capital to fund their lifestyles because they're simply not earning enough interest. So one of the key questions that I often address with retirees is to say, well, you can, certainly put a portion of your portfolio, if it makes you feel better or makes you feel safer, into term deposits and things of that nature. But I encourage them to please put at least 50 or even 60%, keep those monies exposed to growth assets and to assets that will help outpace inflation, because they don't really want to see, if they can avoid it anyway, the capital that they have available eroding. But your strategy that you just mentioned is actually a fantastic one. The retiree becoming the bank for the family is a wonderful idea. The only caveat to that, of course, is to make sure that you document everything well and to have a lawyer prepare everything. Otherwise, you could find yourself in a bit of strife.
That's right. Or owning some houses that you perhaps didn't really want to own. So going to foreclose on the grandkids.
Exactly.
So, I mean, it does beg the question, though. I mean, let's look at how banks make money. I mean, they make money on the spread between, the interest rates, etc.
Yes.
Now, they haven't necessarily changed their spread. In fact, in some regards, they've increased the spread since interest rates have come down over the past, say, 5 years. They've essentially not always passed on the full rate spread. So does it really make a difference for banks? I mean, interest rates can be whatever. As long as they're getting that spread in the margin in the middle, they don't care, right?
Well, yes and no. I mean, I think it's a little bit more complicated than obviously than what you've just described there. I mean, the bank's cost of funds isn't just based off the RBA cash rate. The cash rate that the RBA sets is a metric by which a lot of other funding is priced, but certainly banks don't have a cost of funds of 0.1%. Their cost of funds would be much higher because they generate a lot of their their funds, I should say, from their deposit holders. So all the deposit taking institutions in Australia still need to attract money in, and that's where you see those those sidewalk little displays that have the 3-month term deposit of the week special out in front of the bank, trying to they're trying to attract those people like the retirees we were just discussing to put money in the bank so they can then leverage that and lend it out. So they certainly do, though. In some cases, they don't pass on the full rate cuts because they do need to increase their margin, or they need to preserve margin. Because let's face it, we do need the banks to be profitable. They're an integral part of our economy and our economic system. We certainly don't want them to be in any sort of trouble. And it's vitally important for our economy that banks are able to continue to lend money. So they generate most of their income from the interest rate income, and so we need them to be profitable. We need them to have that bit of spread. The good thing at the moment, though, is, as we have previously discussed, is the RBA is committed pretty much, I think, to not touching interest rates for about 3 years, and to doing some quantitative easing, which is to say they intend to keep the 1, 2, and 3 year rates in Australia very low. And this is why you're seeing these ridiculously awesome fixed rates for 1, 2, and 3 year money. They're often at the same price. So, this would probably be a good time if you have a lot of debt or you have mortgage debt, particularly owner-occupied debt, to consider refinancing your mortgages or contacting your lender and saying, hey, give me a better deal, because there are some very, very sharp rates out there.
Yeah, there is, and we contacted ours 4 weeks ago, and got a better deal on the variable, but the best deal available was definitely on a fixed rate on that 1, 2, or 3 years. It was very, very low. I think we were looking at low twos for major banks, so that was pretty good. Now on that lending, I got some data here. So Prosper Australia put out a tweet or an article the other day, and they said that total Australian land values increased by $422 billion last financial year. That's 20 times more than total banking profits. So $422 billion in uplift of land values across Australia. That's a decent amount of money, mate. You probably have about, 10-12% of that, I reckon?
Oh, I wish. I don't know that you'd be sitting here talking to me right now. At least maybe I wouldn't be in front of the White House. I might be, on top of the Empire State Building or something. But yeah, look, I find it funny how these banks come out and say, that whatever increased, by whatever percent. I think it's ridiculous because it actually doesn't really matter. I often say to my clients that there's only 2 times you are concerned about the price of your property: the day you buy and the day you sell. Everything else in between is just noise. So even if that were true, and let's assume for a moment that what you just said was true. So what? What are you going to do with it? How do you capitalize on that? Well, if you want to utilize that equity effectively, which is what they're saying, that the value has grown, which means that presumably all of us who own property in Australia now have, I guess, what did they say, 10% more? So we've got 10% more value in our
No,
property.
it didn't say 10%. It just said the total value was 422 billion increase. Now these guys push like a land tax and a more, they call it a more even distribution of wealth, and so they're saying it just makes it more expensive to live.
Right.
I went back through, and I agree with what you're saying. It doesn't make any difference. But I went back through and looked at how much lending as an average happened that year, and it looked like that value increase of 422 was about 2.5 times the value of the amount of lending that happened. So, you divide that by 2.5 or whatever it was, and that was the amount of lending. It was about 14 billion a month that was in lending. So it was just an interesting correlation. If that's the case, then X amount of lending happens, but the actual value increases by 2.5 times.
Yeah. Again, I don't know how they come up with a lot of these metrics because it's like anything that you put up for sale. Like you couldn't sell all of that at one time to one investor. So prices vary based on supply, demand, the availability of credit, so many other factors. And that's why I think a lot of that stuff is just white noise. It's just stupid to even, mention something like that because I'm not saying you're stupid, but these guys that came up with it,
No,
it's just
that's it. Well,
stupid to
that's it for
even.
the day. Thanks. I'm just going to go home and cry because
Beep. Give me
PJ called
the
me stupid.
give me the end of
Hang up
the
the phone.
day.
No, look, I agree with you. That's why I wanted to bring it up because
Yeah.
it's a metric that you can throw around. Oh, $500 billion value increase. Okay, that's great. But as you said, unless you're buying or selling, unless there's a transaction, and let's not even get into the fact that okay, let's sell the lot. Well, you can't, right? Because there's not enough Australian dollars in, that's just a whole topic for another day. And who's going to buy every piece of Australian property? It just doesn't
Yeah.
exist. So I
No.
100% agree with you. Those metrics are weird. I was more interested in the correlation between value uplift with
And the lending.
loans.
Yeah.
Yeah, because
Um,
if we see loans come out and there's more and more lending coming out, we might be able to start to predict in across the area, where certain things might be rising in value and where are undervalued.
Sure. So, I mean, with regard lending, we've probably discussed this. It's been a while if we have even talked about it ever, and that is the fact that in order to get asset price appreciation or inflation, you have to have credit growth. So, in order for your house to go up in value, the banks have to be lending money to people to buy housing to drive the price of housing up around you. So that's the only way, really, in this current economic system that we have, that you're going to get value created. It's not even, I wouldn't even call it value, but you're going to get inflation in assets is by credit growing. So the fact that the bank lending, and I don't know if you said if the bank lending numbers were up on previous year or what, but in order to see any asset price rise, you must have some form of credit growth. So in periods where, and you need to look not too far back in history, but certainly during the crash of '06 to '09, where you saw interest rates spike, you saw banks tighten credit, the stock market shit itself, property prices went down, and there's your link right there. That's the correlation: is when credit growth shrinks, asset prices shrink. So there's an interesting relationship, obviously, between interest rates and credit growth, because at a certain point, interest rates rise so far that people stop borrowing money. And so that'll be the next evolution, I think, of this whole thing, is to see when we start getting inflation coming through, what they will do with interest rates and how then that will impact on things like property prices, as an example. So lots of moving parts in this whole thing.
I totally agree. All right. Well, look, PJ, thank you very much for joining us today. It has been an interesting show because we're in an interesting time on so many fronts. I mean, there's, as you just said, moving targets, and every time we talk, there's a new metric or something to talk about and actually try and digest and plan for our clients.
Oh, there is indeed. And it's only going to get, I think, more and more interesting now as the next few months unfold. And I hope that we have a great Christmas here. I know we'll talk again before Christmas, of course, probably several times. But I think the back half of this year now is going to bode well. And then certainly, as I've been saying, the first half of next year looks really good for Australia. So I might just duck on into the White House here and have a quick, quiet drink with Donald and wish him well in whatever he pursues next.
Well, there you go. PJ's called the US election for Joe Biden. So there you go. You heard it here first, and with every other talking head around the place as well, got in their own opinions, because we're all the same, aren't we, PJ? Just
yes, we are.
off at the mouth. All right. Thank you very much, PJ from Keystone, for joining us again today. And we'll be talking about stocks and shares and the Australian economy and the things that happened with the interest rate drop this week on Melbourne Cup. If you want to know anything more about any of the topics we discussed, or you have topic ideas for us, feel free to email us on the details being going on the screen below the whole time, or for those listening on our Xenium Live podcast, you can email us at hello@xenium.live. So HELLO at Xenium, XENIUM.live. No .coms, no .aus. That's all you need. Or you can call us anytime, 1300 66 7789. All right, today we've been talking about all things money, finance, and property. I'm Scotty North, and this has been Xenium Live.